Thank you very much, Vladimir. Jérôme, thanks for having me. There's a joke already going around. Some of you have known me for years, and we only met now in person for the first time. And the joke is I'm an AI avatar, usually, because people know me in 2 dimensions, not in 3 dimensions, but I do exist. So I'm here because I'm a big fan of France. And I'm a big fan of the French construction and construction tech ecosystem. I think France is one of the at least 5 most important markets for construction, and I have a few slides to also speak to that. But also you have this wonderful density in Paris of bringing together construction demand, construction expertise, founders, all in a very, very dense ecosystem. And I'm glad that Jérôme and Vladimir and all of the alliance that you're building is bringing you guys together. So for me, when Jérôme asked me in December, hey, why don't you come over? I said, you know, usually I don't do it because I'm more of an introvert, believe it or not. But this one was obvious to me because it's in France, it's in Paris, and it's done by all of you. So thank you very much. I'm a German, so I only have 150 slides for 30 minutes. So I hope you're not scared. Volume 1, but don't worry, I'll get the 30 minutes, Jérôme. But I also have 3 messages before that. So first of all, France is awesome. You guys are building one of the most interesting ecosystems. 2, what pisses me off is that people speak about productivity in construction as if it was this magical thing that if you do some software that automates a workflow or that standardizes a process is the solution to productivity. My position is productivity in construction has nothing to do with efficiency. It has everything to do with standardization. So that's the second message. And the third message is standardization in markets doesn't happen on processes. It happens on demand. When the demand standardizes, you as founders or you as corporate buyers can now create and find solutions against that demand. And that's how you standardize. And that's why my presentation today is not about this is how much money is going into Contech, or these are the best solutions, these are the big tech trends. No, I'm going to speak about just the construction demand markets that I'm seeing currently, and let's have a conversation about how that can actually foster the most interesting solutions of 2026 and the next few years. So that's my presentation to you guys. And I call that, by the way, project economy. So we at Foundamental, we love construction, but we think it's bigger than just construction. There's infrastructure, there's renovation, there's CapEx-based markets that have their own idiosyncrasies, and we call that the project economy. So let me first give you the market context. Can anyone shout, guess which chart, after this little introduction, can you guess which chart I hate the most that is being spoken about in construction? McKinsey. Which chart is it? Oh man, Owen, I'm so glad I paid you before to be my heckler. I hate this chart because it has nothing to do with the reality. So the reason why we have a productivity gap is not because we need to standardize processes. It is because we need to standardize demand. Now, let's hype you a little, and then I'll sober us a little. So today I'm going to be anti-German. I'll first make you some good feelings, and then I'll bring you down a little bit. So $15 trillion is now the worldwide construction market. And we're going to grow at 5 to 6% over the next years. A lot of that is driven by infrastructure. Not surprisingly, data centers, energy infrastructure, highway infrastructure, China, India, but also defense infrastructure in Europe. So infrastructure is a big, big, big demand driver for all of that growth. If you look at another macroeconomic indicator, the so-called gross fixed capital formation, that is roughly the amount of CapEx, capital expenditures, that goes into all of the markets, my markets, projects, it has grown 30 times over the last 65 years. That is a huge growth. So we actually are operating in an amazing market. And also the technology investing, AEC tech, has become a real category. We're now adding about 3 to 4 billion every year in investments to capture this opportunity. So that's the hype part. Now at the same time, this growth needs to come from somewhere because we have all of this demand until 2040. You know, there are other statistics where we say, hey, half of the world's floor space hasn't even been built yet of 2050. 75% of the world's infrastructure in 2050 hasn't even been built yet. So huge amount of demand, but somewhere it needs to come from. And at the same time, construction is pretty much correlated with GDP growth rate. So you can't just have all of this demand and at the same time expect that you grow much faster than GDP. History is our witness here. It's not. So, and at the same time also we're seeing capital formation concentrating in 5 markets. China, India, US, and 2 European markets, France and Germany. These are the 5 big construction and CapEx markets. So pretty sensible as a founder to also concentrate there. But 40% of that is China and India alone. In the US, you have 14 contractors that generate almost 200 billion in annual sales. Very, very impressive. But by the way, the biggest non-Chinese contractor is who? Vinci, French contractor, right? So in the US, however, you still have 14 that make 175 billion in sales. What I find interesting, though, is that their market cap grows 10 times faster than their revenue. India, Larsen & Toubro, outpaces every Western contractor in 2024, both in market cap growth and in revenue growth. China has 8 of the 10 world's largest general contractors, state-owned or state-subsidized with demand, and they don't grow, although they make a ton of money. So they are consolidating. So where's Europe in all of this? Well, Europe actually is the home to all of the general contractors that make real money, but the stock doesn't grow. Because we're making a lot of revenue growth, Vinci being an example of the largest one outside of China, but we're not adding market cap to it. That's one of the big problems of actually IPOing also in Europe. So does that mean that Europe is on the down? No. It just means that the money is moving into a different part of construction, and that's building products, for example. If you look at Kingspan Insulation, if you look at Heidelberg Cement, if you look at Saint-Gobain in France, these are companies that are printing money. Building products are becoming only more expensive, and construction is becoming more expensive. All of that money, a big part of it, goes into building products. That's my first part, is if you look at the demand of construction, we should be very hyped. It's becoming very big. We don't have enough solutions to actually solve this demand, and a lot of it goes into more expensive materials. So let's talk actually about substitutes for what makes it expensive. So in the US, you see that the construction materials prices have doubled since 2020, since the beginning of COVID. That's a real problem for construction. In the US, in the EU, the construction producer prices have pretty much moved in lockstep with the United States. We see that cement is up 2.5 times, steel is up 2 times since 2020. So it's becoming very expensive just on the material side to actually build for construction. Construction machinery, not exactly the same problem, but also up 40%. So now, if you go back to McKinsey's productivity chart, if you take out China, the picture is even bleaker. If you take out China's productivity gains, you're seeing that in the US we're really deep negative on productivity because the prices have gone up so high. And in the EU we are barely flat. We're barely flat because prices. And at the same time, the prices then also manifest in the workers. So we know that pretty much every Western workforce is projected to shrink. We're retiring hundreds of thousands of workers in the UK, in the EU, in the United States, just adding to the problem. Remember, lots of demand, where's the supply? So now comes my favorite chart, my favorite 2 charts. So the first one is this representation. What is actually the cost drivers in construction? Look at the chart. You see materials, you see men, you see machines, and somewhere across all of it you see money. But what you don't see here is software. I don't see AI on the chart. Let me represent it to you differently. I once made a representation of how the P&L of the construction industry looks like. It's roughly this. It's roughly this. So again, you have about 35–40% men, you have about 35–40% material, you have about 10% machines, and across all of that you have money. Software, 2%. You know why? Because the project economy is an outcome economy. We need to put things in place. We need to move atoms. We need to stack them. Nobody cares if that one HR process in construction is 10% more efficient. It doesn't show in the P&L. It won't. And that's in spite of the demand is there. You need to fix supply. That's my message. And technology investors have tried, like myself, we have tried to fix supply. We have that was before Fundamental, invested a lot in 3D printing. I don't think that's a supply that we're using much in construction. We have, niche solutions, but ultimately it's not a supply that solved a huge amount of demand. Alternative materials, as much as I would like, low carbon cement or better substitutes for existing materials to succeed, we're not seeing them at large. I think regulation is to blame here also. We're very, very cautious with that. But ultimately, we're offering a new supply, and it doesn't match the demand. Modular construction. I mean, who here doesn't have an opinion about modular construction? My guess is all of you, right? So do I. Again, it hasn't fixed it. We have markets where they have 1% market share. We have markets where they have 10% market share, but that's about the peak that we're seeing. So modular construction, again, it has offered a standardized supply that doesn't meet any kind of standard demand. Although they really, I think I actually stripped out Katerra here. If you added Katerra, there would be 3 billion hidden somewhere. Yeah. But even in 2021 was the peak investment year. Heavy equipment, another source of supply. We also saw investment there. Equipment share had an IPO. Oh, and when was it? Was it end of last year or beginning of this year? Just round, right? Yeah, so great IPO, great for all of us. But that's the success story. Other than that, we haven't really fixed much supply on the heavy equipment side. So founders need to answer, where in this P&L am I fixing supply to match demand? How do I make your demand so much better that it shows up in your P&L? And in my opinion, a better AI for a better fractional process, you have to find an answer for that. Which brings me to the drivers that I look for in construction. So I think there's 5 drivers on the demand side that people offering a new supply can really tack onto. It's reindustrialization of the West, not just in the US. Europe is building a lot of manufacturing capacity right now and bringing it back home. Data centers, obviously. Energy infrastructure, also obviously. Civil infrastructure, because we're still consolidating people in fewer and fewer places. And then defense infrastructure. So let's go through them one by one. I can tell you one thing, banks are not financing construction and infrastructure as much. In fact, what you see since the mid-1970s, roughly 1974, that most of the capital that used to go into construction, into building factories, into building infrastructure has moved away. It moved into derivatives. It moved into notional value. It moved into stocks. It moved into any kind of financial product but atoms. It moved away. You know who did it else? China. China did the exact opposite. They didn't subsidize their stock markets, they subsidized their atoms. And India is now doing the same thing. So we're seeing in the West this realization, hey, we actually need to move capital back into construction to build new forms of supply because the demand is obvious. Which is now what we're seeing in European manufacturing. We can be very proud of this. You're going to see in 2 to 3 years a very different manufacturing ecosystem in Europe already. So we're seeing on the PMI that it's moving up. That's a leading indicator, and we see that also in the United States, next to the EU, so that the offshore capacity is being cut nearly in half. We're really moving our manufacturing capacity back into Europe. Data centers, same story, if not more extreme. 500 billion of CapEx is going to be added to the global construction TAM. Now we're of course also running into bottlenecks there. Who's actually the people on the ground building data centers? Now the famous founder that gave us Katerra, or the famous investor that gave us Katerra, thinks he can IPO a data center robotics company. What's it called again, Owen? Rose? Oh yeah, ROZE. Yeah. Again, he sees a great trend and offers a solution for it. Smart. Energy demand as a result of that, but also as a result of us reconfiguring our energy mix, the infrastructure demand is skyrocketing. So great time for us. Which means that we're investing about 1.4 trillion into renovating our transmission and distribution lines. Which means for me, and I'm coming, wow, I can't believe how quick I was. Which means for me as an investor, I'm very much interested in solutions that build new capacity of supply, but that matches the reality of demand. What is actually that? So for me, now it gets nerdy. So hear me out on this one. In Foundamental, we're looking for 3 types of companies in 2026 and the following years. We call them Synchronizers, Synthesizers, and Systematizers. So Synchronizers are companies that if you want to have a very, very crude metaphor are marketplaces, but they are more than that. So synchronizers are companies that find demand that is standardized. That can be demand for money, Reda. That can be demand for machines. That can be demand for materials. But always on the level where pretty much every customer has the same demand. I'm looking for the companies that can address a standardized demand. Not at the level of modular construction. Hey, here is my wonderful new type of building. Now please people buy it. That's not a synchronizer. A synchronizer is a company that goes into the unit of demand that already exists everywhere. And then they aggregate the supply to offer against that demand. A company in our portfolio in India, Inframarket, is the world's largest procurement platform for construction materials. They have a good market in India. It's growing a lot. It's booming a lot. Fantastic. They make over 3 billion in revenue. That's a synchronizer, but also there are traditional examples. So Brad Jacobs' company, XPO, big logistics giant, is a synchronizer. McDonald's, I argue, is a synchronizer. Most of us think of McDonald's as a restaurant chain. They're a real estate company that just basically offers people a brand, aggregates demand. People come into your restaurant that you own and they give you recipes and the ability to procure cheap ingredients. It's actually a synchronizer. It's not a restaurant chain. Coca-Cola, the same thing. Did you guys know that Coca-Cola is actually not bottling their own beverages? They go into local markets like in Africa or Europe, etc., and they go to a local bottling company and they say, I'm going to give you a contract. You can have my brand and you will bottle for me 1 million bottles next year. I'm buying your capacity. And I'm buying your capacity because I'm Coca-Cola. I know that I will sell this amount of thing, but you have to take the CapEx risk. You have to invest in your factory, you have the utilization risk, but I'm going to guarantee you that you can use my brand. They are not taking the CapEx on it. They own the brand above that, and the demand that is standardized comes to them. Now the bottler says, that sounds like a great deal, because I know that I will make a ton of money. But I, as the bottler, I'm taking the utilization risk and the investment risk. That's a synchronizer. These kinds of companies I love in construction, because they address a uniform amount of demand in men, machines, material, and money. These are the 4 resources in the P&L that, in my opinion, you should address. Synthesizers are a little bit different. So synthesizers create a new form of capacity that doesn't exist today. That can be a new form of material. So for example, a new low-carbon cement, if you think there's enough demand for it. But also if you take a construction company like Goldbeck, I would argue they're actually a synthesizer. Because they standardized first parking garages, then they standardized warehouses, and then they standardized office buildings so much, on the level, however, that the market wants them. So they didn't try to sell a new type of demand. They said, okay, there's the demand for parking garages. Let me standardize that radically. That was the 1960s to 1980s of Goldbeck. Very well done. Outside of construction, SpaceX is a similar example. They've standardized launching into space. They have a monopoly on that now. Didn't exist before. So I like these kinds of companies, but you have to find a unit of demand that is insanely repeatable. So if you synthesize a new type of supply, but there is very niche demand for it, it might not be the company worth building. So that's something to keep in mind. What unit of demand can you synthesize a new type of supply for? And then finally, probably the most exciting ones, if you can find this opportunity, is what I call a systematizer. So these are infrastructure type businesses like Visa or MasterCard. So you can basically offer the rails on top of which any kind of supply and demand gets exchanged, gets underwritten, gets de-risked. So that is pretty cool companies, very difficult in construction. In construction, what I look for here are data infrastructure companies. I love these kinds of companies, especially in an age of AI, but also fintech companies. So fintech companies that offer the rails of exchanging working capital, again, the money of the 4 M's, man, material, machines, and money. If you can offer fintech to allow the facilitation of working capital or even the compression of working capital in the entire industry, I think it's a very fantastic type of company. I call that systematizers. So nerdy chart over, last chart. So ultimately, against these 3 types, what I'm looking for in 2026, data infrastructure for projects. I think these are very exciting solutions for the buyers. Robotics integration, Owen and I will talk about that more, what that means. Working capital distribution, a key problem and a key demand. And then still the automation of pre-construction defines a lot of what happens downstream. So these are just 4 of the themes that I'm quite interested in. If you work on any of them, I'm around. Hit me up. So in conclusion, I'm German. Allow me a British joke, Owen. Owen, what is the difference between a British chef and a terrorist? Not a lot? Well, you can negotiate with a terrorist. Thank you very much.
Patric, thank you so much. We didn't plan for you
quick, no?
to be so quick. So there is an extra point here. Before we start with Owen, do we have any questions for Patric? This is your chance now. And why not?
Hello. Okay. Hello. I'm coming from Spain. We are a wood manufacturing company developing solutions, industrialized solutions in timber.
You're a synthesizer.
Yeah, exactly. And my question is, you were talking all the time about CapEx. We know that construction is very intense in CapEx.
Yeah.
But what do you think about new ways of financing buildings with OPEX? Because if you use industrialized components, you can turn that to the OPEX.
Yeah.
And this is also a circular economy, and this is maybe there's an opportunity there to create new businesses.
I love that you're asking it, because again, in the Fireside chat with Owen, I can go a little bit deeper into it, but very quick. I think it's one of the most exciting infrastructural opportunities. I don't make predictions. My personal guess is that in 10 years to 15 years from now, we will see a lot of private financing of infrastructure, as well as of over-the-ground type of construction. And that would have to come in the form of either leasing or similar types of OPEX models. So I'm very interested in that. And I think for that, by the way, you can also build infrastructure type solutions that I just mentioned. Great question.
Hello? Okay. First of all, thank you. Really, really interesting. Sam Eliyahu from the Israeli Center for Construction Technology.
Nice.
And one of the things we're seeing in Israel is a massive boom in founders who typically would go into cyber, fintech, enterprise softwares, entering the construction tech space. And what I'm interested in, for those founders who are coming from different places, who are looking at the industry and seeing how slow companies scale in this space, and access to capital, what would you tell them to convince them, stick to the industry, enter, start solving problems for us?
Yeah. So if I had the perfect answer, I think we could all just call it a day and say, okay, problem fixed. But I do think if you're coming from the outside, and especially from a very well-funded category, like cyber in Israel, it can be quite frustrating for you that the same method where you're developing a great technology and then you're going through buyers who are used to buying technology, can be very frustrating that that is not the case. My biggest advice would be you need to just reinvent yourself of how you build companies. It's not technology first, it's literally being very forward with your customers and understanding exactly what unit of demand do you want me to solve for you, and how often can I repeat that unit of demand. In cyber, you don't really have that problem because it's sort of obvious when you're an expert and you're coming from the intelligence community, etc. You know that. You have that empathy and you can be very certain that you can repeat it across the globe. In construction, you need to crack that first. So it needs a different approach.
One more.
I'm going to. Sorry. David from a startup in construction. I'm not sure I'm buying the standardization approach, because my guess is it might be a cultural point of view, which works in countries where standardization is in your core, in your heart, like in Germany, in China, in Japan. And I would like to elaborate more on what freedom can you give to people to enhance their practice. Because today, I guess, the main construction software we have running the world are Word and Excel. And why do people spend their time on them is because they have the freedom they need. So if you might elaborate on that.
Let me try to convince you, Daniel. So I'm an economist by training. I didn't work as an economist, but it's how I did my undergrad. And so some of that thinking is informed by that. Let me try to convince you. I would argue, Daniel, construction is already standardized. It's standardized at the lowest unit of supply that also has the lowest unit of demand. Bricks, 2x4s, steel rebar, nails, dowels, yellow machines. So you see where I'm going with this, right? So it's not like construction isn't standardized. It's just standardized at a lower unit of demand. And what we have been trying, offering technology or offering new materials, is we jumped to a higher unit of demand where there is no standardization. Do you want my big, beautiful building 1,000,000 times, and you can configure it a little bit, and you can buy expensive faucets, and by the way, I raised 3 billion? Do you want that? No. I want my building that way. So, but I'm happy to buy bricks from you. I'm happy to buy rebar. I'm happy to buy nails and dowels. And by the way, I'm also taking your men, your machines, and your money. That's where it's standardized, right? So I think the point you're making about standardization of processes follows a very similar logic. So if, for example, my partner Dustin on Foundamental, he used to own Building Connected, a pre-construction platform. Now he runs Edify, a pre-construction automation platform. If he were here, he would say, even in pre-construction estimation in the US, people don't even use the same terminology between different parts of the market. And then you go to Canada and they use completely different terminology. And when you use the wrong term, they throw you out of the room. So it's at that level that I'm looking for standardization. If you can attack it there and you find the repeatability, then you can drive into the market. That's what I'm excited by. Now tell me, Daniel, did that answer your question or is it different? Okay, thanks.
Okay, Ronnie, this is an exception. I wanted to close the session, but...
Thank you, Patrick. Ronnie from Hive Autonomy. We do self-driving heavy machinery and other things.
Nice.
And I'm struggling with this sort of thinking around how we organize construction. And construction has some similarities with other industries where there's a lot of people that's actually doing the work. So you have the same in government, construction, all these sort of sectors where there's a lot of people and you have to orchestrate all those people. And they also have low level of productivity or at least perceived productivity in those. Do you think there is a connection between that and what we're seeing? Because I've been out working sites for 10 years, and the difficult thing is actually getting all the information out. And then you don't really get to haggle with your suppliers because you have so much else to do, and there's so many suppliers, and it's this orchestration. And all those industries you see going very well, like banking, has a lot less few people per unit of economics.
Yeah.
Do you see sort of a, if you know where I'm getting?
Absolutely. So I think just two intuitions without having the perfect answer. So the first one is just going back to something I said earlier. If you can standardize something, you can also standardize everything downstream. What kind of information you need, what people need to talk about, the decisions that need to be taken. And because we don't have standardization at the highest level, but at the lowest level, we see a lot of this orchestration demand. That's why I'm excited by the project economy, because for you as a founder, for me as an investor, there are problems to be solved. And they exist because we don't standardize at a higher level of demand. Now that means, my second point, we need to let information flow. So my framework about that is, an information that doesn't lead to a decision is useless. A decision that doesn't lead to an action is useless, which means that the information that you need for decisions and actions, of which you have in construction or government industries a lot, let that flow. So the most exciting opportunity in that problem for me is, for example, data infrastructure. I'm much more excited about data infrastructure that can help AI run at perfect precision than I am about another AI solution that gives me a 95% correct answer, because it will not allow and enable the decisions that you need to take in construction. Every decision is very high risk. So for me, data infrastructure that facilitates this flow, information, decision, action at perfect precision, I'm super excited by it. Again, not a perfect answer, but two reflections on it.
Patric, thank you so much. I think
Thank you.
we'll have more time because now we were considering inviting a British cook to France, but instead we changed our mind.
Well, he's even worse in cooking.
Yes. So instead of him making a meal for us, I'm happy to introduce Owen from Brick and Bytes. Please, one big applause.
Thanks, Ruben.
Hello, hello. Testing. Okay, we're all good. Well, Patrick, I'm glad you made a joke about a British chef and a terrorist. Because yesterday, when I arrived to St. Pancras Station to get the Eurostar over to here, I was faced with a 3-hour delay. And I thought maybe I wouldn't get here at all. And what ended up being was me spending about £56, which in euros maybe is 65, 70 euros,
Yep.
on some chicken and broccoli in St. Pancras Station. So,
Wait, that was your meal for 70 euros?
yes.
Wow.
Cooked by a British chef.
For you.
It was okay. Okay, look, hi everyone. We're going to do some questions with Patrick on the presentation. Well, in fact, we're going to split this in 2 halves. First half, I'll give you some general questions about Foundamental and what you guys are looking at that you didn't cover in the presentation. And then the second half, we will focus on some of the stuff you did cover in the presentation. But before we get there, I wanted to give people a little bit of an insight as to how you and I met.
Oh, God.
So back in 2022, we were just starting Bricks and Bytes, and we would try our hardest to try and get some of the top people on Bricks and Bytes. You know what it's like when you're trying to get something off the ground. It can be hard, it can be a slog, it can be tough. You have to do lots of outbound to a lot of non-response. And every now and then we would see this mysterious German guy posting stuff on LinkedIn. And I thought, his posts are kind of interesting. Let me try my luck. His title was General Partner at Foundamental. And I had no idea what a general partner was at that time, or does. And in fact, I still don't know what a general partner does, but I'm working it out. So I sent you a few DMs. And for some reason, we just didn't make it happen at the time. Whatever, everyone's busy. And then a year goes by or so, and I see you outside another event, by the way, which was in London. And I saw Patrick, and I feel, this guy's tall, and I'm pretty short. And I was like, let me go up to him and shake his hand. It was a little bit intimidating. But I went up to you, I shook your hand, and I said, Patrick, we finally need to make this thing happen. How do we do it? And he said, shoot me a message on LinkedIn. I thought, brilliant. Here we go again. So the first thing I did when I got on the train on the way home from me and Patrick was open up my phone, open LinkedIn, shoot Patrick a message. And he responded. I thought, oh, here we go. His response. Timing is a bit off. I thought, timing is a bit off. It's just a polite way of saying no, right? I'm sure we all get the timing is a bit off thing every now and then. But anyway, another few months went by. We started engaging on LinkedIn a little bit more. And I thought, you know what, one last effort. Let me try and do this thing. I think this is maybe 1 to 2 years later now from our first interaction. And I sent you another DM. By this point, you're probably thinking, fucking hell, who's this guy? And I sent you a weird message with this text in it, and it said, hey, Patrick, we've been pseudo-interacting on LinkedIn. I don't even know what that means, but you agreed, so you must have meant something. But you said yes, but it wasn't just yes. You said yes, but I have a proposal. And I thought, a VC with a proposal. He's either going to offer to give me a fat check so we can take Bricks and Bytes to the next level, or he's truly going to tell me to fuck off. Anyway. So a few weeks go by, and the tension is building. I'm looking forward to hearing what this proposal is, and maybe the dreams are about to come true. We're going to get some money to take Bricks and Bytes on a different trajectory. And we start chatting on this meeting. And I've been avoiding the question for some time. It went on, and I said, hey, Patrick, come on, tell me what this proposal is. And he said, yeah, I want to come on Bricks and Bytes, but I want to do a 3-hour podcast. And I'm thinking, 3 hours? So not only has this guy been avoiding me for 1 to 2 years, not only has he not offered to write me a check, he's now asking for a slot 4 to 5 times longer than the average slot that people get on Bricks and Bytes. Inside, I was not pleased. And under the intense pressure of a German staring down his webcam to me, and of course my British politeness, I said yes. So we shot it.
Lucky me.
Lucky you. We shot it, and it ended up being 1 hour, 45 minutes, which was pretty long, which is actually about 3 times the length at the time that we were doing podcasts for. And it ended up being our top podcast on Bricks and Bytes for a good 18 months, which is the equivalent of around about 100 episodes, in fact. So congratulations, Patrick.
Thank you very much. And what a wonderful relationship, no?
Yeah, I agree. 100% agree. So good. In fact, you're now a regular on Bricks and Bytes.
Thanks for having me.
So we got to know each other, and one thing I learned about Patric is he does not do events. So you guys witnessing Patric doing a presentation today is probably as likely as England winning the World Cup this year. And let me tell you why. So when we were planning to do this thing, you CC'd me. I don't know if you meant to CC me in an email with your team, but you did. And on that email, there was a full A to Z of topics of what you wanted to cover in this presentation. I thought, holy shit. My first thought was actually, good luck doing this. But then I thought, you know, there's only really two types of people who, one, actually have the time, resources, and energy to do this, all whilst being a regular on a podcast now, and two, are efficient enough to do so. That's VCs and Germans. Here we go. Okay, enough of my crap jokes.
Let's move on.
Okay, Patric, so what I'm going to do, open this up with a quick fire round, yes or no, one word kind of answers,
You got
and
it.
then we will elaborate.
All right.
Let's do this. AI bubble, yes or no?
Yes.
Which is more overhyped, low carbon cement or modular construction?
Modular construction.
Wow. One word for European Contech in 2026.
Ooh. France.
Oh. Next construction tech unicorn, software, robotics, or a marketplace?
Robotics.
Okay. The most underrated country for construction tech right now. You can't say UK.
So the one that is punching the most above its weight, Australia, then Israel. The most underrated might still be France.
Wow. You're just saying all this because we're in France?
I know how to play to the home crowd.
Okay, let's jump into the meat then, Patric. So you founded Foundamental in 2019. If you were starting again in 2026, what's one thing you would do differently than in 2019? And you can't say you'd pick fintech instead.
No, I love the category. I don't need to go into fintech. That's okay. Probably founder obsession. So I think the thing to really realize when you first get into your own fund and investing is just sometimes you only need to be directionally right, but you don't need to have the perfect articulation of the perfect market thesis and the perfect product thesis. If you're directionally right, but you have a founder or a team that will make it work, I think that appreciation had to grow inside of me. I came from operating, then an executive, and then moving into investing. It's extremely different. So I would say that that's probably the thing that could accelerate me as an investor 2 or 3 years.
So what you're saying, maybe not the most perfectly polished founder when it comes to articulating things, but you can sense something inside them that...
Yeah, I think you have another question about founders later, so I don't know if you're jumping to that with this, but exactly. So founder obsession and just thinking that founder will make it work as long as they're directionally right.
Maybe we should dive into that. Okay, you teased us there. Describe your ideal founder in 2026 then.
So I'm looking for raw intensity, raw obsession, and I'm not looking for friendly, I'm not looking for, be soft-spoken or a great salesperson. I'm looking for raw intensity so that you can break through walls. Secondly, you need the ability to articulate an extremely grand vision, but also reverse engineer the logical steps of getting there. 3, I love founders that are obsessed with bottlenecks, that can articulate all of the bottlenecks that they need to remove to get there. And 4, I love founders that stand with both feet on the ground within their customer side. I love founders who still sell in year 10 themselves than in year 1. So raw intensity, huge vision, reverse engineer the vision, obsess with bottlenecks, and both feet in the customer reality.
Very nice. 100% agree. I've heard you say bottlenecks more in 6 months than a whole few years prior to that. Very cool. Okay, so we said something about AI. So would you say AI is still the #1 thing you're seeing on pitch decks today?
So look, I mean, the same way that you would see internet as the #1 thing in 2001 on the pitch decks of startups, because you can't be a company today without AI. It's an infrastructural capability that you need to own. Does that make you a AI first company? I don't think it has to, but yeah, so in that sense I'm seeing AI of course on every pitch deck because I should, but in a year I shouldn't because people don't say that they're an internet enabled company anyway, it's just a given. So, yep.
And your first reaction when you see AI on a pitch deck?
Yes, so what?
Would you say it's accelerating or slowing down?
So in terms of foundings, of new foundings, the types of foundings have shifted a lot. So 2 years ago, 3 years ago, we were flooded with companies that were wrapping something around documents oftentimes, and that mix has changed. So I'm seeing much less of that. But I'm seeing also more articulated use of AI, for example, in data infrastructure, visual language models in robotics, being applied to the project economy and construction. Everywhere you have AI, but the category and the mix of the category that we're seeing in the foundings, vastly different compared to 2 years ago and 180 degrees different to 5 years ago.
Very cool. Okay. Yeah, I can't remember what you said in your presentation, but it was something along the lines of it's not AI, it's mostly to do with hardware and that kind of thing. I can't remember the word. You can correct me in a second. And so you purposely at Foundamental played the AI field quite cautiously. Why might that be?
Yeah, so it's true. We did not invest a lot between 23, 24, 25 in AI first or AI wrapping companies whose main value proposition was expressed as AI. We played that cautiously because we had a hunch that a lot of them would end up being features in someone else's platform, either because it is going to be a very universal horizontal platform that would get taken by, for example, an Anthropic. At the time, I didn't know that Anthropic would probably be what I would call a winner, but we knew that someone would be. Or you would end up in a feature in someone else's data infrastructure ERP, what I call bathtubs. So you hold the water being AI. So we focused on the latter. We invested in companies such as Speckles, such as Kuro, Kestrel in the US, which are data infrastructure companies for the project economy, more than we did in wrappers of AI.
And maybe it's important to notice that this is just your investment taste, right? Doesn't mean that you can still have a pretty good outcome if building an AI solution.
Because of that taste, I will also have misses.
Of course. Okay, fine. Well, look, at lack of potential of repeating ourselves here, but obviously we're in Paris at Station F. What's the construction tech story, generally speaking, of continental Europe?
So Europe has been at the forefront ever since I've started Foundamental of materials innovation, robotics innovation, less so, however, other things. So if you want to learn supply chain innovation in construction, marketplace innovation in construction, you need to go to Asia. You need to go to India specifically, and if you have the ability to go into China, you should do it. If you want to learn software, if you want to learn the cutting edge of AI applied to construction, that's a US story. And it has ever been since I've been in this market. That's not a European forte necessarily compared to the other continents. But materials innovation, energy innovation, and robotics, I think this is Europe's story.
Anyone building in energy, robotics, material innovation here?
What?
Okay, yeah. Okay, fine, cool. I think you mentioned the US, China, and India as well, so maybe we don't need to go there. But yeah, thinking about our corporate audience who might be here in the audience then, and they're looking at buying some of the best of breed solutions that exists, what should they be asking every tech company before committing to them?
So if I were a corporate buyer, the question I would ask every new vendor, especially when it's a startup vendor pitching me, is first, explain to me your grand vision. If I buy you, why will you exist in 3 years from now? And then secondly, I would ask them, and now tell me what problem you're solving tomorrow for me. And you will be surprised how few vendors can explain you the connect between the two things. So that you will have startups that will be very, very good at explaining you the big picture under a lot of assumptions. And you will have even more startups that are exceptional at understanding a customer problem. Maybe they come from the industry. or maybe they've spent a lot of discovery with the customer, and they will be able to tell you exactly what they can do for you today. Sometimes in maybe too difficult words, but if you spend enough time with the client, they will get it. The connection between the two is a very important indicator for a corporate buyer.
Okay, very cool. Yeah, loud and clear. And maybe to adverse that question, how could they spot a red flag?
So here's a little trick that I developed as a muscle when I meet founders who are very charismatic, very visionary. So at some point you will notice with founders that are not able to do both. By the way, Owen, I call this riding the elevator. So ride into the penthouse, big vision, 30 kilometers to the horizon, but also ride into the basement, into your machine room, and know every screw of your product, of your business, etc. I call that riding the elevator. So that capability, the connect between the two, is very rare. So when you meet a founder that is very good at the penthouse, but they haven't figured out the machine room, when you keep asking them more granular questions, as Patric or as a corporate buyer, you will notice that at some point, after the third time you ask why, or the fourth or the fifth why, some of them have a tendency to say, yeah, but you have to remember the ambition is this. Or please remember, my vision is that. That's when a founder that is extremely charismatic and visionary runs out of the ability to express the details. That's an interesting flag to look for.
So they keep going up, like avoiding the question essentially by referring it back to something at the higher part of the elevator.
Especially because perhaps they don't have the answer because they didn't think about the answer as much, and that's a reveal of, okay, is this a vision pitch or is this grounded in reality?
So you suggest that they keep asking and keep asking the question?
5 whys, man. It's the most powerful method that I have ever learned.
And then eventually you get the picture, right?
Yep.
They don't know. Okay, very cool. Okay, so look, this is a pretty long one, but it's quite a relevant discussion, and it's coming up more so on Bricks and Bytes. And I had a conversation recently with a very large tech company in this space, publicly traded, and they claimed to me that they build features faster than any startup. They spend roughly $300 million on R&D, which is about 25 cents of every dollar of revenue that they make.
Oh, wow.
But they can only go as fast as their customers are willing to adopt. And in addition to that, I was at a conference recently in the UK, and I was walking around and I felt that maybe 90% of the solutions there were not actually built for the user, and maybe a bit too idealistic. And I said this to you, and you said, what, built for a VC pitch deck, maybe? Yeah, maybe that's the analogy to use. But how do you advise that startups actually stay grounded in this space? Would you say that moving quick is a good thing or not?
Are you asking whether moving quick is a good thing?
Well, let's start with the grounded question first, on the basis that, yeah, you have to be mindful of the user. You can innovate quick, but the industry is very slow to adopt. If people can't adopt so fast, then what's the point in moving fast?
So I have made my personal experience that going to a customer and trying to identify a problem, it has never worked for me. Because either the customer can express their problem in 10 seconds, or it's not relevant this year in construction. That's my personal experience. I'm sure it doesn't cover every potential scenario under the sun, but that was my personal experience, always. So I think staying grounded, as in spend as much time with the customer, explore with them a lot, and then ultimately you find a problem, I think that's hogwash. If a customer needs to spend 3 months with you to identify a problem, trust me, it's not a problem. It's not something they will pay for this year. So I don't think it's that. Now, I do think that one job of the founder value creation is reframing problems to allow a customer to see how their problem can be repeated across an industry, so that now you can offer a solution, a supply, that when you build it, it's cheaper for everyone. Whereas if everybody built their own custom solution. That's one source of value creation for a founder. So when you stay grounded, spend as much time with different customers and identify the pattern of demand that only you can make uniform, that only you can really, really, really repeat across many different customers. And that is more true in construction than anywhere else, because every construction company has their own processes. They do fundamentally the same thing, but they use different terminology. They have a slightly different sequence of who they involve, when does the estimator come in, etc. But you as a founder, you're in a very unique position to see that uniformity across all of the noise, and that's a form of value creation of staying grounded.
Okay, very cool. Also, just in this space, I think Eliyahu mentioned, asked a question, and the message I got from the question was about like the excitement, the caliber of founder and people coming into this industry, and definitely we're seeing this as well. And in addition to that, there's been some pretty big funding rounds.
Yeah.
We had the IPO of
Huge.
Equipment Share, as you mentioned. We had Bedrock Robotics earlier this year, 275 million round, total of 350 million raised. We got Field AI valued at over $2 billion, 405 million funding round, I think, earlier this year, maybe, or last year, back end of last year. Okay, general question. What's your sentiment towards like the excitement within the industry right now with the founders and the big funding?
Look, very high, but the variance of capital allocation is the highest it has ever been. What I mean by that is that we see more and more, so we have pretty much the same amount of venture capital in the total market as 2021. And 2021 was an absolute peak year for venture capital. We're back at that level almost. But we're in 10 times fewer companies that it gets concentrated in. So the taper is more high variance than ever. That's why you see, for example, the team at Bedrock or Ali at Field raising these very big rounds. And we see that in construction, we see that in other categories as extreme, if not more extreme. So if you're a founder, unfortunately, the capital allocation puts you right now into two types of buckets, and I think there should be a third one in the future that I'm exploring how I can be a part of that. The first bucket is either you build something such ridiculously civilization level big and can articulate it and can express it and can excite investors, to something like that, and then you can be one of the few absorbers of that mass amount of capital. Or you use 1 or 2 rounds of capital and you become profitable and you build a real fucking business. I really like that category, I have to say. Now, it's of course difficult, especially if you have to build a lot of R&D, etc. But let's also be honest, it has never been easier to build software. Never been easier. The amount of shipping that you can do in a week is absolutely insane. So also the conditions have shifted to the founders' advantages, certainly. I think we will see in 10 years a third category of venture capital, which is we're going to miss the part of the market that supports 250 million exits. Because all of this capital concentration, this high variance, is allowing companies to go for 1 trillion exits. But you know what, Owen, if you built $1 billion business or $1 billion idea 10 years ago, you got capital. If you say today, hey, I can build $1 billion business, nobody's going to give you money except small funds. Because for everyone else, the economics will not work out. And that creates a gap in the market for 250 million exits, which are fantastic life-changing outcome for the founder. But also for the industry, these are very important companies to build. And I think there's going to be a third category that will be dedicated specifically to allowing founders to build 250 million to 500 million outcomes.
Yeah, that's interesting. We hosted a roundtable recently with a few founders who had exited their businesses. I think the values were like around 50 million, 275, 300, and around about that region. But the consensus that came up was there was like a lack of exits around the region of like, say, 300 to 500 to maybe even 500 to 800. And then obviously at 875, you've got PlanGrid and over $1 billion Connect. So what you're saying is you see this field emerge, this area emerging in between those two brackets, say the 300-ish to well, you said 500, but
yeah, exactly. Now, what that also means is a founder needs to build more capital efficient. So you can't justify a 500 million outcome raising 100 million of capital. That doesn't work. So you can get to a 500 million outcome raising 25 million of capital and make it life-changing for everyone on the cap table. But that also means that you have to build that way. Now, with AI, it's possible in many cases.
Oh, okay, very cool. Okay. Look, you said this right at the end. You said you don't make predictions, but what happens in construction in 2027? Construction tech in 2027?
27 or 26?
Let's go 26, and then we'll go 27.
So for 26, I already gave you a prediction on one of our podcasts. So I made the prediction in January that we will have 3 $1 billion IPOs in construction. We had equipment share after that. In my portfolio, I think we will have one this year. So I have a little bit of information asymmetry. And I'm gunning for a third one I'm quite confident we will at least see a $3 billion exit, if not IPO. So I think I'm confident about my prediction from January.
Very cool. 2027. Oh, what was that? 2027?
That was 26.
So,
that was for 26.
Okay, maybe this will feed nicely into the next line of questioning. So 2027, I guess, is more towards the thesis of what you're looking for, which you spoke about today. Four key areas, right? Robotics, data infrastructure, working capital risk, and, sorry, which one did I miss?
Pre-con automation.
Pre-construction automation. I wanted to go into robotics. What's your views on jobs? In fact, why don't I just be quite broad here? Like, tell us about robotics. Why does it excite you?
So look, again, if you think of the four types of supply, men, machines, materials, and money. Men and machines can be addressed by robotics. And we will not be able to meet the demand of the future in infrastructure, be it energy, data centers, transportation and highways, but also vertical construction. We will not be able to meet it by throwing more bodies at the problem, because we're running out of bodies, quite honestly. I mean, the demographics are quite dire, unfortunately, in the West. So we will literally have to have machines working for us. By the way, quick side note, I don't know how it is in France or the US, but in Germany, the chancellor that the Germans voted for is extremely uninspiring. And the same mantra that he has been saying since he took office a year ago is Germans need to work more. I mean, he's not wrong, but do you find that inspiring as someone in the society? Hey, please work more, so that, you know, nobody finds it inspiring. If I were the chancellor, I think it's a super easy message. Let's actually take all of the pension money that we have, create a huge fund with which we will finance robotics. And by the way, everybody can go into early pension with 55, because we will distribute the taxation from the robots through the fund that has financed the robots back to society, and all of the pensions are going to be paid for early, and everybody can go into retirement earlier. I think it's a super easy pitch. I don't understand why they're not doing that. Can you please work until 35, until 75? No, please work until 55. So robotics is a very, very important space for mankind and for the Western demographics, but also for construction, because we will not be able to meet that demand. Now, I think robotics has one problem. So founders tend to be very good at building either hyper-verticalized monolithic solutions that address hopefully a big enough demand, like bricklaying is a company in my portfolio, Monumental, which does a terrific job, and it can be a very big outcome by being monolithic. But that's few and far between. Many that are monolithic actually don't have enough demand to address. Or you can build a company that is super horizontal, and you hope that at some point someone in construction picks you up. I think actually the more interesting solution in 2027 to build for construction and robotics is an integration layer. So there is a concept called systems integration in robotics. In manufacturing, you don't get any manufacturing site automated without systems integrators. So you literally go to systems integrators and you tell them, okay, I have this unique situation. I have a unique factory, I have a unique shop floor, I have a unique process, I have a unique product to build. Does that sound similar to construction? Very unique.
Yeah.
So that's why systems integration emerged, because you needed engineers to sit between the manufacturers of robotics hardware and the adopters and operators of automated systems to translate, design it for me, engineer it for me, come to my site, add the metal to it, add the electrics to it, program the system for logic and motion, integrate it with my other systems. That's exactly what construction needs. We don't need construction to have a uniform supply of robotics. We need construction to have a uniform supply of integration. That's what I'm excited to back.
So just help me understand this. So integration would be, in a hypothetical scenario, someone starting a construction project or planning a construction project, and they say, I need 5 robots that do this. A systems integrator comes in and is like, I'll build those for you.
I'll design it, I'll engineer it, I'll find the right SKUs from Europe or from China. I'm organizing the supply chain, I'm procuring it for you. I'm going to have it all shipped to my factory, I'm going to simulate it, I'm going to program logic, I'm going to program motion, I'm going to bring it to your site, I'm going to demonstrate it. You're going to tell me what doesn't work, I'll take it back, I'll do all of that again. Then I'll add metal to it, you know, cages, feeders, transportation platforms. I'm going to do the electrical work, I'm going to come back to your site, I'm going to show you that it works. You're going to tell me you need one more robot, I'm going to add that, and the system works in your site uniformly across your company.
Very cool. So this would be like a forward deployed robotics engineer.
And that exists already. We do that for 35 years in manufacturing sites and factories. Without it, nothing works.
Very cool. Okay, I have to ask you this one because you mentioned it in your presentation. Rose, the data center robot, is going for $100 billion IPO, no product, just a headline at the moment. Hype or reality?
Hype.
Good signal? I mean, it's construction, it's data centers, like maybe it's bringing some attention to the industry.
So look, technically, I always like capital allocation because it creates fungibility, it creates liquidity, it creates opportunity for everyone. You know, in the end, if you're a hedge fund or if you're a day trader, the best thing you can hope for is variance and volatility. It's not stability. So if, you know, capital moving around is generally a good thing. What that also creates, however, is the troughs, when hype falls back down to reality. So that is something that founders that want to tack onto that hype, they need to be aware of. That at some point there might be a day of reckoning where, because you're being lumped together with that kind of a thing, you might also see a drought of 3 or 4 years. Companies that built in modular construction, they benefited from Katerra, but they also were hurt by Katerra. Similar story.
Similar kind of thing. Okay. A few more questions, and then we'll open this up to if anyone wants to ask some questions for the last 10 minutes or so. But yeah, we quite often hear this data infrastructure layer, and I think it's actually becoming, more people are talking about it now. There's a new buzzword emerging, common data environment, as well as we are the intelligence layer maybe rather than infrastructure layer. Can you just explain like what does it actually mean? What is data infrastructure?
So look, if you want AI to give you extremely precise results, you have to understand, in the end, ultimately it's a statistical engine. It uses vectors, it goes through the vectors to find the most probable next letter. Ultimately, that's it. So it's a probabilistic machine. Now in construction, you don't want to operate with probabilities for most of your decisions. You want to know pretty much as accurate as any highly trained expert human could give you an answer. Now, will the human be wrong? Of course, that's an argument that you will make when you build with AI, but you don't want it to have more wrong than that. If you want it, that's my position, if you want to get to the maximum precision of applying AI, you need to organize your data in a way that ontologically, schematically, it is very uniform for your business to use and reuse and reuse and reuse, so that whatever you apply knows that it doesn't have to rely on a variance of data. You eliminate the variance of data for your business. And then secondly, you need to allow it to flow extremely seamlessly, because you can also have hallucinations in using agents to transfer data from one system into the other, or to map data from one system, or to use data and then reuse it over here. Let me give you a metaphor. If you're a bank, will you guys really use AI to make the computation on the interest rate of what someone that owes you money, your borrower, owes you today? Who would use AI for it? No one, right?
Yep.
You would use a calculator. You would use your computer to do the engine. That's because the calculation is deterministic. It's not probabilistic. So a bank will absolutely never use AI to run the calculations, because there's only one right answer. It's the same with letting data flow. So if you can actually say, okay, this is the source of truth, this is the point of time of information, I've transcribed it into the system, data infrastructure makes sure that immutably you use this information across all of your systems and across all of your AI stack. That's why I'm excited about data infrastructure.
Very cool. Okay, one last question. Someone's got a gun to your head. Out of the 4 categories you mentioned, pre-construction, data infrastructure, robotics, working capital risk, where do you place your chips?
All 4 of them, currently. Yeah, but I think working capital is underserved, especially because fintech has been orphaned as a category the last 2 years. So a lot of investors that used to invest a lot in fintech moved a lot of chips into AI. I'm betting that the fintech craze is coming back. And especially construction as a category needs a lot of money to move around. I don't know if you guys know this number. So there's about 10 billion invoices every year written across construction. 10 billion invoices. The amount of working capital in construction is trillions.
Yeah.
At any given point in time, sorry, trillion, not trillions, plural, trillion. At any given point in time, if you can, with your financial infrastructure or working capital solution, reduce that because you allow that less invoices need to be written, less working capital will be in the system, and you can also facilitate the lending and the movement of money in this, industry, you're solving a huge issue.
Very cool. Okay, Patrick, thank you so much.
Thank you all.
I think we will open up some to the audience. I know we've done a little bit of Q&A before, but maybe there's some more questions as a result of this chat I just had with Patrick. So, anyone? Do you want to do it, Vlad? Or?
Actually, I will use the exclusivity, and if I may start, and then Paco and Grace, I see you. How about solutions from China? Are we kind of blocking them to enter the EU market and the UK and States? Or because so far I've heard when guys have a great solution in Germany or in Austria, they say, yeah, we are great, but in China they're doing miracles. Why are we doing that, and what's going to happen when we remove this roadblock or the border limit?
So I'm going to give you a personal opinion, but not an opinion. I think they're bigger experts than me on that. So I studied in China. I lived in China for a while. I'm actually quite Sinophile. I love the people. I love the culture. And I also respect a lot what China has been done to its economy, but also to its society. So I'm more Sinophile than the average Westerner, by far. But I'm still only having a personal opinion, Vladimir. Now, I think it's not China versus EU, the same way that I don't think it's US versus EU. I think it's sovereignty. In the end, if you have to rely on solutions that you can't produce domestically in the EU, you're importing your survival. Just, you know, the metaphor that always comes to my mind, imagine we were all still a little medieval village. 1200, in the Bourgogne, you know, we're enjoying life, sun is good.
The good old days.
The good old days. You know, you have a carpenter in town, you have someone that does your shoes, you have someone that cooks, you have someone that does the fishing. You know what you're not doing? You're not going to the next village to buy your shoes. You have organized your society so that you're sovereign. You can pretty much supply your own little village and the demand for yourself. Globalization has undone that. Globalization has meant that we imported survival because we gave away lots of the shoe production, lots of the, you know, furniture production, lots of the food production from our little village into other villages, and we hope that the other villages would always play nice with us. That's giving away sovereignty. That means you're importing survival. So I think it's less about China or US. I mean, honestly, are you more excited about buying US software than Chinese software these days as a European? I don't know. I'm hearing different streams. So it's not China, but it is that I think Europe should definitely be sovereign on its technology as well as on its construction sites.
Good morning. Okay, thank you. This is Paco Gómez Escofet, and I'm running the Barcelona Contech Hub. So first thing that we are trying to do is to put our ecosystem among all these 5 markets that you have said initially. Spanish market now it's not as big as the one that you have said, but on the other side we have maybe top 3 or top 10 construction companies in the world. So
ACS, Ferrovial, and
Acciona, maybe?
Acciona.
Good. Okay, my question goes like this. So we are trying to boost our ecosystem to bring as more Contech startups as possible. But compared to other verticals, in our vertical is not all digitalization or digitization. We have materials, we have machines. So the first investment has a big CapEx to put in place. And that for startups that are emerging, it's for us, from my side, it's a kind of block.
Yeah.
So do you think, or how can you address to these startups and try to avoid this, if it's any kind of avoidable process? Because we found that when you talk about fintech, for example, with 100,000 euros, you can build a pretty good software or platform, but if you're building a 3D printing machine, you need to start for $1 million or euros. So do you think that it's a problem in our vertical or not?
So let's say yes and no. I think for 99% of the founders that need to address or that want to address a solution that requires CapEx, venture capital might not be the correct asset class to solve it. And then there's only so few other capital pools that you can tap into. It could be your customers, but they have to be educated and they have to be a little bit of risk taking. So I love what you're doing, because you're bringing together also customers and you're educating. That's something that I do with my type of business much less. EU, of course, there are solutions, but they take time. You know, you can address them. And then banks, I mean, too much risk. They can't really underwrite it.
Do you make, sorry, difference between corporate venture capitals and venture capitals? Do you make difference between that?
Yeah, I do. I mean, of course, every setup is different. But in a corporate venture capital fund, of course, you can still, you have more latitude to justify investments than I have. So I, in the end, need to be purely financially motivated, which brings me to the 1% that I wanted to get to. So for 1% of the companies that need CapEx, it's not going to be a problem, because my capital is actually good enough for them. Now, I unfortunately am bound to back very large outcomes. I don't need the $1 trillion outcome, but I need at the very least $1 billion outcome to be believable, which means that, to answer your question now, if you have such a solution and you require it, you need to tell a grand story, and you need to the ability, and of course credible. So not just, okay, here's my but it needs to be actually credible. Reverse engineer how you get there, identify the bottlenecks, and both feet on the ground how you're doing it this year. Then venture capital can also be your solution.
Thanks.
By the way, in Barcelona, I also have a portfolio company, Theron Theace, so the ex-Privalia founders.
Yes, I know them very well. But there are more, there are big more.
There'll be more.
We should talk.
Yeah.
Thank you. Hi, Patrick, thank you so much for everything that you shared with us today, and thank you, Owen, for leading this conversation. My name is Grace. I'm here from Munich in the TUM Venture Labs incubator, with a focus on the built environment labs. And I really appreciate your focus on the bottlenecks. So there's one more that I would love to hear your opinion on, which is bureaucracy, particularly in terms of certifications. When it comes to new materials, new processes, what have you, and a lot of founders know this, there's certain building requirements that are very localized, so the whole question of standardization comes into play as well. But do you see any way that innovation can happen on a bureaucratic level such that the innovations that we're creating, the new processes that we're designing, can actually then be used, reducing the risk of outcomes?
So it's not something I'm expert on or very familiar with, Grace. I myself find it a fascinating topic. So I think you had a couple of questions. Let me go through them quickly. So one by one, do I see bureaucracy hampering certain types of supply? Yes, especially around certifications for materials, but also new building methods. It's years, if not a decade, until you can truly make a dent. Now, you will know this, Germany has introduced this new type of building class, where, okay, you don't have to have the highest energy efficiency anymore, or you don't have to have every rating anymore, as long as your customer is happy with it. It's, I think, building class E, we call it, E like easy. Now, the problem with that, however, is that when you talk to both developers and general contractors, they say, yeah, okay, now at least from a regulation perspective, I'm allowed to build it, but I don't know if I will get sued 10 years down the line for not being up to standard. So it's not resolving it, I think, the way we would, but I appreciate that's a step in the right direction. So that's the first point. Yes, it hampers. On the second part, do I think there can be innovation on bureaucracy? So again, I think something that is underused in policy making and regulation is actually what the United States Department of Defense, now Department of War, has been doing very well for many years, is take founders, give them internships or fellowships to rotate through their departments and their ministries, and the job is help our department be closer to technology, help them assess technology, help them procure technology, help them talk to technology. And I think that has been a great fungibility creator between the defense and intelligence ecosystem and the startup ecosystem for that. I wish we would do that on every level of bureaucracy, but especially for construction. I think it's such an easy fix. And I mean, I can think of so many founders that would be excited to give back after they have been successful by being engaged in a program like that. So if there are any policymakers here, absolutely do a fellowship and rotate through all of your departments.
Great question.
Since we're almost on time.
Yeah.
The time has gone the other way now.
Yes, yes. I'm very happy that you've been with us. Thank you, Owen. Thank you, Patric.
Thanks.
One big applause.
Thanks. Thanks, Vladimir.
Download the Brella app and see you around.